Ladies and gentlemen, good day and welcome to the Somany Ceramics Limited's Q1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Saknik Sarkar from SKP Securities Limited. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. It's my pleasure to welcome you all on behalf of Somany Ceramics Limited and SKP Securities to this Q1 FY26 financial results conference call. We have with us Mr. Abhishek Somany, MD and CEO, Mr. Shailesh Raj Kedawat, CFO, and Mr. Kumar Suneet, Head Strategy and IR. We'll have the opening remarks from Mr. Somany, followed by the Q&A session. Thank you, and over to you, Abhishek ji.
Yeah, thank you so much. Good morning, ladies and gentlemen. Welcome to the Q1 FY26 earnings call. As you have all seen the results already, there's been a muted demand on account of lower sales in India, and also there's a little bit of pressure on lower exports from Morbi to various parts of the world in Q1. Exports declined to 18,000 crores last year, and I think this year it would be a further decline, a couple of thousand crores is what the current trend is showing. Our sales grew by 4% and by volume 3%. I must make a point here that there is a specific sale of Nepal which adds about 1.2%. In Nepal, we have come to an agreement where, knowing to the specific laws of Nepal, we will be getting this sale profit only towards the end of the year, but the sale does not get counted because it's traded goods, and Nepal doesn't allow to consolidate in the sales in Somany. So if I had to account for that, apple to apple, it would be about another 1.2% growth of sales. Operating margin is marginally impacted due to low capacity utilization. Gross margin increased by 3.2% in Q1 quarter on quarter, and it declined 1.8% YOY. Largely, I would think it is flat. JVs were the places where we had the maximum pressure. On a standalone, we did reasonably okay, although the standalone capacity utilization was also low at 72%, whereas the Concall capacity utilization reduced from 81 to 77. There were three plants which were underutilized. One was the Max plant, which is the high-end tiles. We have been extremely patient to make sure that that plant only produces high-end tiles currently. So some other corrective action has been taken to further improve the capacity utilization this quarter, and it's already showing some signs that by in H2 this would be much better than what it is in H1. On the sanitary ware front, there was a major kiln shutdown. That is back to 100% capacity as we speak, but in the first quarter it was impacted, which was a situation where we had to completely shut down that kiln to repair it completely. It will also yield us better quality and a little better yield, and it's back to 100% capacity. So second quarter should be very good from that point of view for sanitary ware. The depreciation impact was approximately 5 crore rupees in Q1 compared to Q1 25. This is on account of reduction of life of some assets, so an accelerated depreciation. So once again, the capacity utilization at 77%, sales at 601. Correspondingly, you have seen the EBITDA. The EBITDA basically gets impacted, I've said it earlier also, on capacity utilization. So this capacity utilization, we're taking a lot of measures to make sure the capacity utilization is up and running by this quarter a little better, and also H2 would be 100 times better than what it is today. As far as the tile segment revenue is concerned, ceramic consisted of 34%, down 1% from last year same quarter. YOY. PVT is at 26%, down 2%, and GVT is up 40%, up from 37%. Gas prices are pretty much in line. Capacity brand spends will be in line with last year, plus or minus a couple of crores. Working capital has marginally increased by 4 days. Net dealer addition has been approximately 65 dealers in this quarter. Our guidance, we're not changing the guidance. We're still guiding for high single-digit growth and EBITDA expansion of about 1%, and we're very, very confident of the EBITDA expansion if we have a better capacity utilization, and that is something which we've taken very concentrated steps to make sure that goes through. The other salient point this quarter has been that we have concluded the JV with Durabuild. That is starting, the go-to-market will be next month. We're concentrating on all the waterproofing products currently, and then we will move to other patents and other IPs which Durabuild has to offer. We're extremely hopeful and very excited for that new venture. It's a much better margin business. But of course, while we build out the business, there will be certain pressures in the year 1 and year 2. But it's a very, very exciting business of construction chemical. So extremely excited on those fronts. These are the salient points as far as Q1 is concerned. Q2 is already looking slightly better, although there's been incessant rains across north, but still it is slightly better than last year. July was. August is yet to be seen. It's early days in August. So let's see how that goes. We're very hopeful. September should be a great month. This is it from myself, and I would then open the floor to Q&A, please. Thank you so much.
Thank you very much. We will now begin the question and answer session. Each participant is requested to limit himself or herself to a maximum of 2 questions. Time permitting, we shall revert for any further questions that you may have which remain unanswered. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pranav Mehta from Equirus Securities. Please go ahead.
Yeah, good morning, team. Thank you for taking my question. Yeah, good morning, sir. Sir, I just wanted to understand, since you have touched on briefly, but if you can elaborate more on this Durabuild acquisition and how you are seeing things playing out in...
The first few sentences I couldn't get. Can you please repeat?
Yes. So I wanted to understand on the Durabuild acquisition. So you have touched upon briefly, but if you can elaborate more on what is the strategy for this going forward and how it will be, let's say, contributing to the top line and the margins by FY27 and 28.
Yes, so early days to talk on the top line and the margins currently because it just happened. Obviously, the strategy is in place where we're not going to lose money. But just to give you a brief, Durabuild has about 150 different IPs. We bought it for the IPs. You already know what the acquisition size is. Over the next 3 years, we have the option of buying it completely, but we will move up to 75% and then maybe 100% by that time. There's skin in the game for the current partner to maybe earn out more while he sells the 100% within 3 to 4 years. Specifically, we are getting into construction chemicals. Out of the 100 IPs, we're concentrating on the waterproofing piece. The waterproofing market, as what we estimate, obviously we're not in the market, so we have not 100% data, but we have 90% strong data. The market which we are trying to focus it is approximately 6,000 crores, and we are currently at ground zero right now. So that is a market which we are trying to get, and he has IPs of waterproofing material, which is literally starting from the waterproofing which goes into the concrete while the house is being built or the building is being built, right up to the bathroom and the wet areas and the terraces, and also waterproofing for the wall in case there are leakages in the wall or cracks in the wall. So it is called a crack proof. Now, pretty much all these products are available with industry leader Pidilite and various other players like Sika, Fosroc, Mape, Asian Paints, etc. So that's the segment which we're looking into. There is also another segment which we are thinking of getting into, which is admixtures, because in the concrete, the admixtures for residential and building products, and this is not infrastructure, this is only for residential and commercial buildings. Admixture, that's another market of approximately 6,000 crores, which goes into as an additive on the site or in with RMC plants. So we are gunning for currently an 11,000 crore rupee, 12,000 crore rupee market, and both of those we are virtually at ground zero. This particular company was only selling approximately a couple of crore rupees of adhesives and about 7-8 crore rupees of admixtures. So it's admixture is the B2B, and the waterproofing business is both B2B and B2C. We are going to leverage our dealership, and there are certain dealers who are dealing with these kind of products. We're going to attract some of our larger distributors also to see if they want to start this business with us. Plus, we will be also getting into certain hardware shops and certain other specific waterproofing and admixture, waterproofing stores, the stores like paint stores, various hardware stores. But we did a little bit of a dipstick in a lot of our dealership, not a very significant amount, but a good 10-15% of our dealership also is now been dealing into waterproofing for some time. So that's the business we're getting into. We are currently doing all the packaging and all the go-to-market. We should be ready to go to market in B2B, B2C for waterproofing towards the end of September.
Okay, sir. So my next question was on this. So as you rightly mentioned that the demand continues to remain relatively challenging. And let's assume this year also the exports continue to face challenges, then do you think that in the industry, the receivable part and the realization on the realization part, the worst is over, or do you feel that still some competitive intensity might increase from Morbi's end?
No, I think the realization part is not going down. If you see our realization also is down a couple of rupees, but that's not because of price decrease. That's because of the product mix. Although we continue to make sure that we sell higher product mix, but in Q1 generally it is a situation where some lower product mix also goes. So, and some second quality materials, some old delete items, we've sold a lot of that, and therefore the reduction. But from a price front, in fact, we've taken a small price increase in July. But there's been no further price decrease, so to say, apple to apple. As far as export is concerned, current trends are showing that it will be in that same 18,000 crore rupee range. But the kind of quality which is being compromised from Morbi is really not competing with us anymore. And frankly, Morbi is only surviving. As most of the Morbi brands, I obviously don't mean the industry leaders from Morbi, but 95% of the brands in Morbi are only surviving because of extremely high scale evasion of taxes, of GST. And that has also reached a peak where there is no further scope to evade taxes. They're already billing at 10-11 rupees a square feet.
Okay, sir. And sir, on the receivable part for the industry, more or less...
Sorry, sir. I'll tell you about that. The receivable part, thankfully for us, we've gone down on receivables by a day. We are absolutely on the ball there and not losing focus. So touch wood, receivable as far as we are concerned is only better than what it was last year, while it is a pressured market. And we're not seeing any further changes there. Or any further movement there. So even in July and August, we are absolutely on the ball.
Sure. Thank you very much.
Thank you. Our next question is from the line of Sneha Talreja from Nuvama. Please go ahead.
Hi, good morning, team, and thanks a lot for the opportunity. Just a couple of questions from my end. Just wanted to deep dive into the current demand scenario in the domestic market and any improvement that you are seeing in the export market also, because that will define the competitive intensity from Morbi-based players. So firstly, from that front.
So demand hasn't further gone down, it's under pressure. We have grown, even in July we've grown. So from that perspective, I wouldn't say that demand is further muted in India. Yes, there's a little bit of pressure because of especially in the value-added segment where the scope of tax evasion is that much higher. That's the only one which is a little bit under pressure. But we are holding prices. We've in fact increased prices a little bit, and we are also holding on our receivables. So from that point of view, this is the domestic demand. As far as export is concerned, we don't export a hell of a lot. However, our export will probably go up by 10-12% because our base is low. But overall export will be lower is what the trend is showing. But one never knows. In export, there is those couple of months which do cover up. Even if you see last year, till H1, the trajectory was showing that it would be only about 15,000 crores. Then it made up, and finally it touched about 18,000 crores. So that's where the export is. It's not picked up, but has it gone down further? Very slightly, not a very large amount, but the trend is showing that it's not going to be more than 17,000. But I'm the wrong person to ask for export. Probably your channel checks in Morbi would give you a better idea on export.
Got that, sir. Got that. Secondly, sir, the peer is, into another level of cost cutting measures that they are taking. So just wanted to understand 2 to 3 things from you. Are you following any of those cost measures along with the leader? That's first. Do you see any implication of those cost-cutting measures coming to you in the form of maybe, some ad spends cut and some market share gains? So some of these aspects, in case you can, touch upon, that would be really, really helpful.
Yeah, I can't comment on their strategy, but as far as we're concerned, we didn't have such costs. We had a single person at the top where all the vertical heads working. We don't want to change that. We don't have separate divisions other than at the corporate level where there are separate vertical heads for GVT, PVT, ceramics. The only other team which we have, which is working separately, independently, is our sanitaryware team, but that's been there since inception of sanitaryware. And now the adhesive team, which is separate, but it's already been separate since inception. So we didn't have any large costs. But yes, when going is tough, then in legacy companies, there are certain costs which you look at even more carefully. So if you've seen our employee cost, my employee cost has remained the same. Our increments have been, we have given increments, unlike some of the people who have given non-increments. We have given increments, but we've been very, very cautious of that. And touch wood, our team also has been very, very cooperative on that front. If you would see that this year we should be able to reduce, if we grow in the humble digits also and not the high single digits, even then we will be able to reduce our employee cost as a percentage of revenue by 1%. So we're very careful on that account. As far as the other costs are concerned, in terms of advertising, which is the other big one, the advertising cost we are not reducing, but we are maintaining. So as a percentage, it will probably remain slightly, maybe a little more, but nothing very substantial. The other cost which goes down, which we are looking at very carefully, is making travel more effective because, as you see, travel has become extremely expensive. So we are being a little more cautious, using a lot of teleconferencing facilities, video conferencing facilities to make sure that reviews, travel, etc. is under check. Obviously, it can't be so much under check because it becomes counterproductive. But to answer your question, we are not following anybody. We have our own strategy. We don't have such crazy costs on human resources. But yes, there is obviously enough and more can be done to make the current resource more productive. We have taken one action. Every year there are certain attritions which happen. In some places we have not filled those gaps. Those are nothing very major. At all levels we've not filled up those gaps, and we have extended the people's territory, and maybe at the plant also we've extended a little bit of their responsibility. But those are not crazy numbers. They're 20, 30, which we have not further replaced, and rather extended the current team's responsibility. So we are very focused on not letting costs go up. while demand is under pressure.
That was really, really helpful. So thanks a lot, team, and I'll get back in the queue.
Thank you. Our next question is from the line of Rehan Syed from Trinetra Asset Managers. Please go ahead.
Yeah, good morning, team, and thank you for giving me the opportunity. So, sir, I have two questions. First, on the SMPL investment side that we have done. So, sir, for the proposed 50 crore investment into SMPL, could you outline the expected return profile, payback period, or either how it fits into the company's broader growth strategy?
Sorry, can you speak a little slowly? I'm not understanding. The line is very unclear.
Sure, sir. So, sir, my question is regarding the SMPL 50 crore investment side. So, you have done 50 crore investment into SMPL. So, could you outline the expected? Hello, am I clear?
No.
When your voice is muffled, can you just put?
Are you talking about Somany Max?
Sure, sir. I'll just shift my. Oh, it's you. Hello.
Yeah.
Hello. Yes, sir.
Yeah.
Please go ahead.
Yeah. So, sir, my question is on the side of SMPL 50 crore investment. So, for the proposed 50 crore investment into SMPL, so could you outline the expected return profile or either payback period, or and how it fits into the company's broader growth strategy for going forward?
So this is, we have taken the approval from the board of 50. It's not that we're going to spend the entire amount. It's an approval which has been taken. This has been taken to further augment Max to make sure that I'm running at full capacity. So we are going to be adding certain presses there because the current press, which is a Continua press, is inefficient on certain sizes. It is only efficient on the larger sizes. But to keep the plant running and not have shutdown costs, we are adding two traditional presses where we would be able to produce the slightly non-value added. In the interim, at least that will reduce my losses from shutdown costs. And also we are putting in certain other balancing equipment to further augment the value addition. And we are putting a warehouse because this non-value added which will happen, this will go into a separate warehouse because we don't have space in the current warehouse. So therefore, we will have to augment the plant to produce the other warehouse. And the rest of it is because the plant is loss-making, it is to cover certain losses. But this is all through internal approvals. We're putting in the money, and the payback is quite decent if I had to look at any shutdown costs. So we are hopeful that we will not be doing any shutdowns in the plant, and we'll run the plant at full capacity, which gives me a lot of benefit even on the gas and on the production cost of every single material, be it the high-end material or the low-end material. That is the reason. But we won't be spending the 50 currently. This is only empowering us to take a permission for 50 crores. I hope I'm able to answer.
Yeah, sure. It's a very well-defined answer you have given. So my second question is on the retail footprint expansion side. So what is the current number of exclusive showrooms and multi-brand outlets, and what is the target by end of FY26? And how is the mix between urban and semi-urban geographies we are evolving for going forward?
Retail expansion continues. We are at 65 dealer addition, and we will be adding approximately to 250 net additions of dealers. And we have targets for that as to what our net addition of dealers will yield us in terms of sales. So retail expansion continues in mostly tier 2, tier 3 towns. Okay. And some unrestricted areas of tier 1 towns.
Okay. And then, my last question, if we just cater this also, if we assume how much percentage of revenue or other margins we can expect for 2 to 3 years down the line, can you just comment what number?
Sorry, can you repeat how much percentage of revenue? What?
No.
Your voice is muffling a lot. Can you please?
Yeah, sure. So if you can put some ballpark percentage of what we can expect revenue or either margins growth for going forward.
Your voice is still muffling.
I think the margins are not going down further, so margins would only improve with capacity utilization. Like I mentioned earlier in the call, this year which we are pretty sure that our capacity utilization will be back in place to last year levels or probably much better than last year levels, which means that we will be adding to about 1% and a half on margin as a certainty.
Okay.
We're very confident.
Okay, sir. Okay, sir. Thank you for your time, and I'll just send the contact.
Thank you. Our next question is from the line of Lokesh Maru from Nippon Indian Mutual Fund. Please go ahead.
Hi, thanks for the opportunity. So two questions from my side. One is just an extension of what Sneha asked. Like, for example, if the leader attempts to, let's say, 2 quarters down the line or whenever attempts to gain volume, right, once they gain that margin, if they try to give that away to gain more volume via maybe cut in realization or so, and if that gap bridges with our realization, do you think, how are you trying to fortify your position in the market on that front? That is one. Number two, second question is regarding, in market where it has been challenging to grow high single digit volumes, how are you thinking around market share gain, and what are the areas which are major focus? It could be anything like distribution, like you said, retail expansion or product or technology. But how can that eventually pan out, and how are you thinking around that aspect? That's all. Okay.
First question is margins. If anybody thinks that they can reduce margins, already an extremely commoditized business, and we are fighting Morbi where there's high scale tax evasion. So if one thinks that by reducing realization or reducing prices on a sustained basis they can gain volume, I think it will hurt them more than gain. That's not the right strategy. It erodes the brand, it erodes the gain. So, but yes, we've been able to bridge the gap between us and its leader, and we will continue to bridge the gap, and we are extremely confident of that to bridge the gap continuously. Market share cannot be gained beyond the point with just reduction in prices. That's a knee jerk. It happens for a quarter or two, and then you're back to square one. So that's my answer on the market share, and I don't need to fortify myself. In fact, my challenge is that how I can use my capacity better at better realization. I'm not even looking at reducing. We're going to be making better products. We're going to be innovating. We're already innovating on products. If you do some channel checks, you will see there's been a large difference between what we were doing earlier and what we're doing today. Dealers are a lot more happier with the kind of designs and kind of innovation we're coming out with. Long way to go, but that's the focus, and the focus is not to reduce and go down on commoditized product. It's all about value addition and going up the value chain. So that's as far as that is concerned. Your second question was what? I'm sorry.
No, sir. Those were the two questions. One was on the discount realization part, and other was on the market share. Thanks a lot for.
I think the domestic market is flat. If you look at most of the Morbi players, they are flat, except a few exceptions there. Therefore, from that point of view, if we keep growing at even this pace, we are taking a little bit of market share. Over there, the market share is extremely fragmented, and it's more on evasion. So I don't think that's a sustained way of doing business where you're selling products lower than your cost. So I believe 70 to 80 plants have already shut in Morbi. I see more of them getting shut in the next near future. So there will be a consolidation in the next couple of years if this is how it continues. Our balance sheet is strong. We're not taking the eye off the ball on balance sheet. Our continuous focus is on value addition. Continuous focus is on capacity utilization. Obviously, that's both of them have been in pressure. But while we do that, we keep our balance sheet under check. And I'm very, very confident that we will be able to do both of those over time. It is a brand which has been selling a lot of mass products. It takes time to move up the value chain, but it will happen.
Thank you so much, sir.
Thank you. A request to all participants, please restrict your questions to 2 questions per participant. Our next question is from the line of Udit from Yes Securities. Please go ahead.
Yeah, hi sir. Thank you for taking my question. So since you mentioned that you are sticking to your guidance for this year, have you seen any improvement which is kicking in, or the hopes are on H2? This is, and also in extension, in terms of the max plant, what was the utilization, and are you seeing any structural shift or anything happening for, or more towards mass market or low-end tiles?
There are two segments. Mass market is a separate segment, value addition is a separate segment. There is a larger demand and larger traction for value-added segment. Obviously, it's a very small part, but there is more and more traction happening. And at Max plant, to answer that question, we are at about 51-52% capacity utilization. Therefore, we are putting these presses to make sure that we go above 70-75% capacity utilization in H2 or more. So that's the idea, to produce a little bit, not the entire mass product, but a little lower quality product, lower price product than what we're doing in Max currently, to avoid any further shutdowns. So that's as far as the Max plant is concerned. As far as distribution is concerned, it is going to be tier 2, tier 3. We continue to add distribution.
All right, sir. And so what would be the B2B mix for us, and how is that pie growing?
It's the same. It's about 75 to 77% is B2C and the rest is B2B. And all efforts are on to see how we can increase the B2B by at least 5-6% so that we are able to use capacity utilization. But while doing that, we are also very careful of our receivables, because B2B is where you get stuck with receivables, and which we don't want.
And so similarly, like receivables, what would be the margin differences between the two? Any kind?
Projects is obviously depends on the project. Some projects buy also the value added, but generally there's I wouldn't know on the back of my hand, but about 4-5% difference in the margin between retail and projects. But it's not more than the margin is the delayed receivables which further impacts the projects.
All right, sir. Thank you, sir, and all the best.
Thank you. Our next question is from the line of Anubhav Goel from Cosma Ventures. Please go ahead.
Hi, sir. Sir, can I get a region-wise split of our sales?
Approximately 38-39% is north and about 27% is south, and the rest is kind of equally divided between 40. Okay. North, I'm sorry, is 41%, south is about 27%, and the rest is divided between east and west, and 3%, 2.5-3% is exports.
Got it, sir. Got it. And sir, just a general question on the industry. So, like, are we finding, small guys at very low bases innovating on designs? They come, to attract architects in terms of designs and trends. Like, is that become more so important in today's time versus, say, a decade back? And like, how are we placed on that front?
It's not a question of attracting architects. I think these smaller players with single dealers, they're able to incentivize the architects a little more. But beyond which, it's not a specific trend. We have seen Morbi always have these 3-4 players which do well and then they crash and burn. Now also we're seeing in Morbi, there are 1 or 2 industry leaders which are obviously doing well, but under them there are 5-6 people who are coming up with designs. But at the end of the day, it's their finance is tax evasion. You remove the tax evasion and they don't have any finance anymore. They're able to do all of these investments basically based on high scale tax evasion. And the more higher the margin business, the more attractive is the tax evasion and incentivization.
So, sir, for these small players, maybe at say 50 crore sales, 70, 100, where we feel they might be doing better on terms of designs, the tax evasion point would apply to them as well.
Yes, correct. They're not doing better on terms with designs. It's just that they have a single dealer in a particular state or particular city. They have 2 dealers. Obviously, there's not much competition. There's a small base. They're able to incentivize the dealer more. They're able to incentivize the consumer and the architect more because of this. But it's not that they have better designs. That's a very, very subjective term. The smaller players do not have better designs.
Got it, sir. And sir, you mentioned, I think even we have taken a lot of work versus earlier in terms of, becoming more aggressive in terms of our design. So we are doing work on that front.
Yes, and we are doing another launch in September and then another launch soon after Diwali. So you'll keep seeing better and better products and better designs coming from us.
Okay, sir. And so just my final question on our Max plant. So this, where we are playing the GBT, so this would be sort of mid-premium, right? In today's market, not like very high premium.
Oh, Max is premium. Max is not mid-premium. The investment which we're doing is to go to mid-premium, which is part of the plant will go to mid-premium. We're pushing for the premium, but I don't want to dilute the premium to just get into mid-premium. So the idea would be in the interim to stop any losses and therefore shut down losses. Therefore, we are going to make the plant a little fungible, not entirely fungible, a little fungible to make also the mid-premium, which is pretty much everybody is doing that. Even industry leaders have done the same thing.
So, sir, so you would feel the opportunity is massive. It's like, or is there a thought we need to, keep trying to go up the value chain in terms of realizations? Or you feel the opportunity is massive enough?
The opportunity is massive in both areas, in both the commodity, not the really commodity, but the mid-premium and the premium. The IC tiles has extremely commoditized, low margin, but still a lot of opportunities for people who have good balance sheets and have a good distribution.
All right, sir. Got it. Thank you so much. Thank you so much.
Thank you. Our next question is from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
Hi, thank you for the opportunity. So one thing I want to understand, normally if we see your Q4 to Q1, that is Q1Q, the volume decline, possibly what we see the industry leader would be around 20%, but you are somewhere around, let's say, 10%. There is a good gap of, 10 to 12%. And we have seen in earlier years also at times. So what is the reason for the same?
So Q4, generally you pressure the system and sell probably 10, 12 days more in Q4. And plus the government also is finishing their, they need to spend their money. So obviously Q4 on all accounts in India is higher. Government spending need to be saturated. They need to spend their amount to get the next year's budgets. So therefore, everybody is looking at, picking up as much material. We also have certain incentive schemes for dealers, which are yearly turnover discount scheme for the year. In case there is somebody who's lagging behind, they try to make up that so that they get that annual incentive. So all of that, generally Q4 on any building material industry, not only tiles, any single building material industry would be higher than Q1.
No, I understand normally Q4 is higher than Q1. My question is more if I see Q1Q decline, which for Somany is 22%, while the same number for industry leader is 10%. So there is a big difference of 12%. So is there anything different maybe?
If Q4 wasn't as good as ours. That's the difference. If you look at Q4, our growth was much better.
Understood. Got it. And one thing, normally the accelerated depreciation which was charged for, last 2-3 quarters, which was supposed to, get over in Q4. This time also we see the depreciation is higher. When you feel the depreciation will get to a normal run rate of, let's say, 19-20 crore, which you have guided earlier?
So Keshav, it has normalized, and we have explained this in last Q4 call also, that it has reached to new normalized level, which is annually number of around 110 and odd crore rupee, plus minus 5-7 crore rupee, and we would be remain at that level. Earlier it was lesser, and we have done a certain revision in the life of assets, certain key equipment, and that was resulted into this increase. Now this is by and large the normalized level.
Got it. That is helpful. Thank you.
Thank you. Our next question is from the line of Utkarsh from BOB Capital. Please go ahead.
Yeah, hi. Good morning, sir. So my first question is regarding your own manufactured plant sales volume. See, our own manufactured tile sales volume has been under pressure for the past 8 consecutive quarters. So can you please help us understand, is it because that the market size for our own manufactured tiles is shrinking, or we are facing stiff competition from the Morbi players, so we are not able to grow our volume over the past 2 years?
No, so first of all, trading you're seeing gone up because we sold two of our joint ventures, and both those joint ventures are actually supplying to us the same amount at what they were supplying earlier, so nothing has changed. It's just that we're not in a JV, so therefore you see the trading volume going up. But yes, our particular plants, the pressure has been on the volatile. What we are doing currently is we are doing investments, small investments in balancing equipment to make these plants fungible to make also flow tiles. So from H2 onwards, most of my volatile plants, other than what I need for volatiles, will become fungible to produce even floor tiles. So we will see capacity utilization go up significantly in H2 in our manufacturing.
Okay. And so, like, what would be a gross margin profile for a max plant, say in the June quarter compared to our other plants? So whether there would be a significant gross margin difference? Yeah.
Oh, that's too granular a question. We talk of gross margins, but yeah, Sunil wants to say that.
So, Utkarsh, actually the gross margin of max plant would not be a right number to reflect upon as of now, considering the kind of capacity utilization we are operating at and the suboptimal product mix itself. Though we are operating at 54%, but that too is a suboptimal product. So, would not reflect the right number. I think once we are coming with this investment and that will start probably towards the Q4, then next year onwards this would be giving a right number.
Okay. And so lastly, what would be our maintenance capex guidance amount for FY26?
That is same as last year. Nothing has changed.
Okay, thanks a lot.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on their touchtone telephone. I repeat, anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question is from the line of Bharat Kudikiala from Choice Institutional Equities. Please go ahead.
Hello.
Yes, sir. Please
Hello.
go ahead.
Yeah. So can I get some color on region-wise profitability? Like one region is good, looking good, and one region is not attractive at all.
Not audible. Can you repeat, please?
Hello. Can you hear me now?
Yes.
Sir, we can hear you.
Yeah. Can you give more color on like a region-wise profitability? Like some region is attractive and some region is like not attractive.
I can't understand you. I'm sorry.
What is after reason-wise? Heard you till reason-wise, then what's that?
Yes. Region-wise profitability.
Profitability?
Yeah.
There is no region-wise profitability. Our profitability is between retail and projects, but we don't count region-wise profitability because in every region we are selling the same kind of product mix.
Okay. And can you give the like a split between bathware, like sanitary and faucetware, revenue of sanitaryware and faucetware, a split?
Yes, just a minute. So, sanitaryware, our revenue was 63 crores, which is sanitaryware and bath fittings combined, up from 61 crores. And this would grow at about in early double digits for this year. We had a plant shutdown in sanitaryware in the first quarter, therefore it was lower, but we are absolutely in complete trajectory to grow at low double digits for this year for sanitaryware. So that's doing well.
Yeah, faucetware revenue, like bit of faucetware.
Faucet and when I say sanitaryware, it's sanitaryware and faucets combined. But
Okay,
if you want granular, faucets went from 28 to 31 crores, but sanitaryware was flat. So sanitaryware, this quarter will be much better. So therefore, we are absolutely on track for growth of early double digits.
Okay. And like, can you give a gas price for QoQ growth and?
Little bit, but largely across India, largely flat.
Okay. Thank you. That's it from my end.
Thank you. Our next question is from the line of Vivek Tulshan from Newmark Capital. Please go ahead.
Hi. Could you share the total profit made or the loss made in the Max plant for the last quarter? And would it be fair to say that that was the key reason why the difference in profitability exists in the standalone and consolidated basis?
Yes, approximately 5.5, 6 crore rupees has been the 6.5 crore rupees has been the loss from the Max plant. We're going to reduce this loss significantly, and that's been the impact on profitability, which over H2 will reduce, and next year would probably be not there. So very, very confident of that.
Got it. Thank you so much.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on their touchtone telephone. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you, ladies and gentlemen. As there are no further questions, we will now hand the conference over to Mr. Abhishek Somany for closing comments. Over to you, sir.
Thank you so much for attending the Q1 earnings call. Like I said, challenging times, but when challenging times, you also find opportunities. We're looking at opportunities, are extremely confident of increasing our bottom line and also increasing our top line this year. Taken many, many corrective actions to make sure that our consolidated only betters our standalone. Because on the standalone front, we've done okay, but on consolidation, one or two plants which have given a loss. Sanitaryware is back online. Max maybe will take another quarter, but will be completely back online. So extremely confident on both those fronts. Look forward to the earnings call around Diwali. Thank you.
Thank you very much. On behalf of SKP Securities Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines. Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming con calls.